We're going to talk about the slew of retirement changes that are afoot coming in the years ahead. Plus, back half of the program, we're going to be joined by fellow certified financial fiduciary Rob Field to talk a little bit about the difference between return of investment versus return on investment. A lot of conversation about things like CD rates, annuities, things like that out there, but you got to be careful on how the calculation is made. There is a difference. It sounds like that one little letter might not make that big of a difference, but rest assured, return of investment is very different than return on investment. So welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your money or your dollars, hence dollars and cents, right? My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of folks that stand ready this week to help you change your life with a successful and cost-effective financial plan. So certainly a busy week. As we talked about last week on the program, we anticipated it to be a very busy week of headlines on two fronts. First of all, earnings season continues, so that always generates a lot of company-specific headlines. And then, of course, as we talked about last week on the program, felt pretty confident that we were going to see another bank take over on Monday of this past week. And lo and behold, that's exactly what happened with J.P. Morgan Chase taking over First Republic. Sort of the bigger banks are, I guess, getting bigger. That underscores the definition of too big to fail, I suppose. But the other comment that we made last week, which also seems to be playing out in the headlines that we saw this past week, is that expect more of this, because once we see the beginnings of banks having issues, you've got to be pretty confident that it's not just one bank. We don't believe that this issue is going away anytime soon because of how rapidly the Federal Reserve has raised rates. A cumulative amount of 5 full percentage points, thanks to Wednesday's additional quarter point increase this past week by the Federal Reserve. So you've raised it by a magnitude of 5 full percentage points in terms of that overnight lending rate. And that has a dramatic impact on banks, particularly when we think about how a bank operates, right? So a bank makes its money because, remember, banks are businesses too. And so they are just as prone to leverage or bad decisions or doing things that when the environment shifts as dramatically as it has, it can come with some pain. So one of the ways in which banks make money is that they take the money on deposit and they go ahead and invest it in an investment portfolio. Traditionally, that investment portfolio always sort of very secure, very safe. One of the safest investments that you can make on any money is, of course, the U.S. Treasury. The problem is that that doesn't mean that it always goes up in value. And in fact, when the Federal Reserve raises rates, then, particularly as quickly as they have, then the value of those treasuries, value of those holdings can be down. Now, obviously, you hold them to maturity, no issues, but if you have to sell them before maturity because your depositors want their cash, well, then there you go. And now you're selling them at a loss. You got less money relative to the amount of money that was on deposit, and then that can very quickly cascade. So that's what's happening out there. The reality is bank failure is just a normal part of the landscape. There's been over 560 of them at last count over the past 20 years. So don't let these headlines alarm you, but as we said last week, expect to see more. It seemed like as the week was wrapping up, there were some other banks that were sort of making some headlines as well. We don't think that trend is going to disappear any time soon. And so if you're interested in reading a little bit more about our thoughts on this, we actually have a blog post on this very topic in terms of what you need to know about your cash at a bank and how all of that sort of operates. So obviously relatively timely blog post that you can check out on our website at nelsonfinancialplanning.com. Just go there and you'll see a little tab that says From the Desk of Joel Garris. That's where we kind of have all of the blog posts in there. And when we think about how rapidly the Federal Reserve has increased rates and how that affects banks and particularly banks' investments, all of that we talk at length in there in that new blog post. Along with, we get into sort of something that's troubling us in terms of the Federal Reserve's actions on these banks these days, and that is this sort of everybody gets a trophy philosophy that the Federal Reserve is exhibiting. Because at the end of the day, some of these banks deserve to fail, and folks that did business with them need to understand the consequences if they're putting a bunch of cash in a bank that may not be in as good of financial shape. And the notion of the Federal Reserve stepping in and being there no matter the amount of cash, we've seen over the past couple of months a waiver, if you will, of the FDIC limit of $250,000. We think that encourages poor behavior in the banking community. And so if everybody gets a trophy and there's no repercussions of kind of who made good decisions and who didn't, then ultimately I think we may very well see more bank failures. So in the blog post, we also have some advice on some of the things that you as an individual need to be looking at when it comes to your money, and your money on deposit at whatever the banking institution is. Also in the blog post, we talk a little bit about ESG investing. That's certainly a topic that we've been talking a bit about over the course of the past few weeks. So that's also in the blog post as well, particularly when we think about the Department of Labor rule and how that plays out. Remember, the Department of Labor rule involving ESG investing only applies to qualified retirement plans, which is typically things like your 401k, 403b, things like that. It doesn't, at least at last count, it doesn't apply to your IRA because that's not a qualified employer plan. So what that means is that at the end of the day, if you want to kind of avoid all of this ESG craziness, then you can ultimately wind up shifting. When you leave your employer, that sort of underscores the importance of rolling the 401k over to an IRA. So, and then we outline in the blog post some of the additional reasons why that sort of makes sense as well. But one of the new reasons is to avoid some of these ESG restrictions that the Department of Labor puts on qualified retirement plans. So that's, and the reason, of course, we say ESG craziness is at the end of the day, I don't care what you screen for as an investor or as a financial planner, financial advisor, those kinds of folks. The reality is that the bottom line is you want the most amount of profit. And don't get hung up in what's making it or not making it based upon some other factors. Bottom line is investment results are driven by corporate profits. So if you want the best possible investment results, look at corporate profitability. That's the driving factor in that decision. So we're going to take a break. We come back. We're going to talk about some of the retirement changes that are headed your way. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We're going to talk about some of the big retirement changes that are headed your way over the course of the next few years on this segment of the program here at Dollars and Cents. So welcome on in to the program that helps you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio program, coming to you on a host of stations throughout the Central Florida region. Also, one of the top 25 financial planning podcasts on the World Wide Web. So no matter where you are, you can get our program. Make sure that you subscribe to us on your favorite podcast or social media platforms, and then that way you'll get notified when we upload new content. Have any trouble finding our channel on your particular platform? Go to our website, Nelson Financial Planning, and you'll see some icons. Click on the one that looks most familiar. You'll get immediately connected over to our channel. My name, of course, is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning. So there is a slew of retirement changes coming your way thanks to some of the legislation that has passed in Congress over the course of the past year or so. First and foremost has to deal with the required minimum distribution age. And what we see there is we see them increasing that required minimum distribution age. Used to be 70 and a half, then it became 72, now it's 73, and it's expected to go up to age 75 based upon where current legislation is. So that has a dramatic impact of when you are forced to take money out of your retirement account. So here's the way to sort of figure out which of those ages is going to apply to you. So if you were born in 1950 or earlier, then your age 72 applies in terms of the required minimum distribution. Before the year 2020, that was actually 70 and a half. So that moved 70 and a half up to 72. Again, born before 1950 or earlier, then you have a required minimum distribution of age of 72. If you were born between 1951 and 1959, that window sort of in the 50s, if you will, then your required minimum distribution age is 73. If you were born 1960 or later, then your required minimum distribution is now 75. So that's kind of how the numbers work. So just think of it that way. If I'm born before 1950, then I got age 72. If I was born in the 50s, then I've got age 73. And if I'm born 1960 or later, then my required minimum distribution age is 75. So just know that those ages are changing and increasing along the way. So obviously that's a significant change over where things used to be. Similarly, speaking of the required minimum distribution, they have reduced the penalty associated with you missing that required minimum distribution. Now, required minimum distributions can apply in a couple of different cases. We all know the traditional one of, I get to a certain age and I now have to take a required minimum distribution out of my account. So that's certainly the case. And again, that age has increased as we were just mentioning. The other part where it applies is on an inherited retirement account. And so the rules now are that you've got to take out a required minimum amount, but you also have to take out the entire balance of that account within a 10-year period of time. So you can delay the larger chunks or take them at different points in time over that 10-year period, but you still have a required minimum distribution that you have to take out on those inherited retirement accounts. So that's where those required minimum distribution rules come in. What was highly draconian, if you will, is if you missed it, then not only, of course, did you have to pay taxes on it because it's ordinary income, but there was a 50% penalty on the amount that you should have taken out. So if the required minimum distribution was $4,000, you paid taxes. Okay, that's $1,000 roughly, and then you have to pay a 50% penalty. So it's $2,000. So of the $4,000, $3,000 goes away in the form of taxes and penalties if you miss your required minimum distribution. That's a pretty draconian penalty, if you will, that applies for you not taking your required minimum distribution. Anyway, they fixed that. They reduced the 50% down to 25% beginning in this year, 2023. And they also gave you an opportunity to sort of correct that in that the penalty would further drop down to 10% if you timely correct it, which generally means within 2 years of when you should have taken the required minimum distribution. So the required minimum distribution penalty rules have even gotten a little bit more flexible, giving people the opportunity to sort of correct if they missed a required minimum distribution, more importantly, dropping the penalty as well. So certainly some big changes there in terms of how your retirement accounts would work. Similarly, the Secure 2.0 legislation that passed previously in Congress also allowed for Roth options on things like simples and SEP plans. So a simple plan, typically a smaller employer, did not have a Roth option or a Roth sleeve available prior to this legislation. Same thing on a SEP as well. A SEP, typically a self-employed type of pension plan. Now you have the Roth option in both of those. And that's sort of the trend of some of these changes where there's sort of an encouragement, if you will, to making those Roth contributions. Now, why do you suppose that is? Well, if you know the difference between sort of a Roth versus a traditional, the Roth you do with after-tax money, which means what? That means that money goes to the IRS in the form of income taxes because you're funding your Roth on an after-tax basis. So a real big push in some of this legislation to, hey, let's get people to do more Roths. Why? Because that means that we'll get more revenue today versus later because we really need the money to pay for all of our nonsense up there in Washington. So you saw that same change happen in terms of the catch-up contributions. Catch-up contributions, which is the extra amount that you can do into your 401k. So like this year, 2023, that's like the extra $7,000 that you can do if you're over age 50. Those catch-up contributions are starting in the year 2024. So not this year, but next year, those catch-up contributions must go into the Roth piece or the Roth sleeve of your 401k to the extent that your wages are above 100 and 45,000 in terms of what it was from the previous year. So sort of a mechanism where, particularly for higher income earners, which is where doing the traditional actually makes more sense because you save more on the taxes because you're in a higher tax bracket, really forcing higher income earners to the extent that they're doing that after tax Roth or the catch-up contribution to do that more on a Roth basis. Similarly, those IRA catch-up limits are now going to be increased for inflation starting in the year 2024. So again, see this push more to the Roth side of things. In terms of a couple of other items that are also changing on the retirement side of things, 529 plan funds that were unused, and for the most part, that's rare because of how expensive college is. But if you have unrealized 529 college savings funds, then you have an ability to roll that over to a Roth IRA starting in the year 2024. There's a $35,000 limit. Obviously, you've got to have earned income in order to have a Roth. And the 529 account must be at least 15 years older. So it's got to be an account that's been around a long time and sort of a residual amount. Qualified charitable distribution, great option. That limit at $100,000, that is now set to be indexed to inflation. So that'll help increase that along the way, giving people an option to be able to make charitable distributions directly from their IRA and get the immediate front page tax offset on that rather than having to go through and itemize. Similarly, student loan repayments would qualify for matching 401k contributions beginning in the year 2024. So a few of these all kind of crank up next year, but certainly to the extent that you're doing student loan repayments and there's an employer match on the 401k, then you actually get the employer match to apply it to the student loan. So those are just some of the many, many changes that have happened on the retirement side of the picture. Certainly many with applicability this year and a lot with applicability next year as well. So a lot of changes afoot on the retirement side of things. We're going to take a break. And after these messages, we will return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On this segment of the program, we're going to talk about the nuances between return on investment versus return of investment. And for that, we're joined by one of our fellow certified financial fiduciaries at Nelson Financial Planning, Rob Field. Welcome on into the program.
Good morning, Joel. Always glad to get a chance to join the show, share some insights with our listeners.
Direct from the Nelson Financial Planning Studios. For those of you who have not been to the office of late, when we did our addition here on the building, we also added in a little studio. So it's kind of easy to to do this. It's all just right here on the home base. The other thing that I wanted to just mention briefly before we started on the conversation about return of investment versus return on investment is you and I as well, along with the rest of the team, are certified financial fiduciaries. And so one of the things that makes that credential unique is that that credential comes with it the highest fiduciary standard in the industry. But one of the things that also makes certified financial fiduciaries unique is it actually just recently became, and I'm sure you saw this as well because they were sending out a lot of information on this, or the organization was, it also just recently became one of 11 financial designations in the country to obtain a sort of a third-party accreditation. So I thought that was kind of neat to be able to see that with that certified financial fiduciary designation, which is a relatively new designation out there.
Correct. We were one of the first offices to really decide everybody in the office would be a certified financial fiduciary. That we saw that fiduciary phrase tossed around a lot, and in general terms, oh, that means I'm going to be responsible for you, and I'm going to do what would be good for you. But the certified financial fiduciary designation holds us accountable to the fact that we're going to do what's in their best interest. That's because right. You could certainly say, oh, well, this investment or this idea is suitable for you. That could work. But everything that we are presenting is actually what is the absolute best interest of our clients. And we're held to a standard that we must do that with that designation.
Right, and it's the highest standard in the industry. And great to see that it has now become one of only 11. I mean, there's an alphabet soup of stuff out there. Financial planner, financial advisor. I mean, just a complete soup out there, which in our view has led to a lot of confusion in the overall investing public. But certainly great to see that there's this particular credential now been fully accredited, and one of the very, very, very few. So anyway, so we digress on that. A lot of people are asking this question. A lot of people are getting hung up on sort of what the return of investment means versus the return on investment. We see that particularly with increased conversations about CD rates, money market rates, and things like that.
Right, and annuities also. That's where there's really a big difference when you talk about that. And as you mentioned, I'm getting a lot of phone calls from clients and prospects who want to talk about investments that involve interest rates. The stock market being down last year has a few people scared, maybe sitting on the sideline. Interest rates have gone up, and as they go up, sure, it's costing you more money to borrow, but people are really noticing the difference on what their bank CD might be offering or what is a money market rate paying. And the numbers are becoming so competitive that people are considering moving out of equities for a period of time and over into something that has that higher interest rate. So as I get those phone calls, I start to pick up on some themes where people are confused about what the interest rate really means versus, how much am I really going to get? What is my return versus what is the yield? And the conversation comes up a lot about, am I getting the money that is being sent to me? Is it my own money coming back, or am I actually earning money? Am I getting a yield? Am I getting a return? And so, because of these conversations, I wanted to jump in on a segment and just kind of clear up a couple things that I had seen. I think the thing that pops out the most is interest rates on bank CDs.
Right.
So I'll see somebody will call me and say, I know you're telling me that your money market is in a certain range, but I was just told by my banker that they have a CD, 3-month CD, it's going to pay me 4%. And they think that's 3 months from now they will get a 4% return. And if you annualize that, the bank's not paying 16%. Right. But it's
well, no, let's hope we never get to that environment where we see CDs at 16%.
I was when I was younger, just going into college, and Jimmy Carter was president, that you were borrowing money in the high teens, but your CDs were paying in the high teens, and everybody was happy with it.
Yes. Unfortunately, inflation was relatively high then as well.
Very much so.
Which is one of those things that I think people need to remember is great. I can get 4.5% on a money market or a CD or whatever the case may be. But if inflation's still at 6%, well, then I'm not making anything at the end of the day.
We go back to purchasing power. You could throw your money into something that earns 2-3% and think, okay, I'm safe, I'm getting growth. And then we had a client yesterday who said to us, I'm doing all these things and I have all this money invested, and yet it seems like I have less money because I go out to buy things and it costs more. And so, as great as 4.5 on a money market, and that is available, sounds, when inflation's higher than that, at the end of the day, you feel the pain.
Yeah, reduction in purchase power. That is for sure. And so when people see those rates, they think that is what they're going to get on a 3-month or maybe a 9-month. But that's the annual rate. That's not actually what you're going to get back in terms of your profit.
Correct. That's not your. That's a return. Sure, you're going to get 1% technically every 3 months, and if you kept buying the same CD 4 times in a row, then you hit your annual number of about 4%, maybe even a little bit of compounding. But the 3-month CD is not paying you 4% at the end of 3 months, but it's an attractive number. It's catching people's interest. The money market numbers that we talk about, they're always an annualized. And that's why the CD number comes out at 4%. It's trying to tell you what an annualized number is so you can compare apples to apples. What's the return of this? What's the yield on a money market? What is the stated rate of return on a certain investment? They always try to talk in annual numbers, but it can be confusing if you don't realize that number they're telling you is an annual number, not the 3-month, the 6-month, or the 9-month.
Well, and that's where this concept of return on investment versus return of investment really, really requires a moment to sort of understand that, because oftentimes you'll hear, particularly on the annuity side, where there's percentages. It's, oh, you're going to get 7%, you're going to get 8%, but that's not the return on the investment. The return on an investment, folks need to think of okay, what's my profit here?
Correct.
I mean, that's the best way to think about that versus return of investment. Well, wait a minute, that's not, I'm not making money on that. If you're just giving me money back, that is the return of my investment. That's just getting me back what I already put in.
Correct. When we talk to our clients about generating income, we try to talk in numbers as in, let's not hit your principal if at all possible. Let's generate an income off of your investment that would go above and beyond the value. And so we talk in that 4% range, which is conservative. But if you can stick at income of 4% of whatever your investment is, if the markets are averaging 5, 6, 7, maybe get up into the 8s, you're in good shape. To make it competitive, though, we get the same phone calls from somebody saying, well, you're telling me 4, my annuity company says they'll pay me 8, 7.5%. So why can they pay out more than you? And the case is what you were just describing, and that is they're just giving your own money back. Our goal and our job, especially as a fiduciary, is to have your investments grow, maintain their value, or grow, generate some income somewhere down the road. An annuity's job is to simply take a lump sum of money and over a period of time pay it all back to you with maybe a small amount of growth. And I say that small amount of growth because when we break down the actual internal rate of return on an annuity, not the 8% that they're throwing you that your own money back, but just the growth portion internally of the annuity, it's in the 2% range.
Right.
So if you lose all control,
which is your return
of an investment.
That's right. Exactly right. So if my return of the investment is, or the return on investments, it's easy to get confused on what means what, but
sure.
the actual return on my investment is only 2-3%. That's not going to allow me to get much growth, because when we talk about the concept of compounding and growing money over time, that relates to the return on investment. And in terms of ultimately getting growth. We're going to take a break and continue on with this conversation here on Dollars and Cents with Joel Garrison, Rob Field of Nelson Financial Planning after these messages. Return of investment versus return on investment. There's a pretty significant difference between those two. So on the program here on Dollars and Cents, my name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, joined by one of the fellow members of the team who also happens to be a certified financial fiduciary as well, Rob Field, talking about that distinction, which is a pretty dramatic distinction between those two concepts.
Very much. We were on the subject of annuities and why annuities are really considered a return of your money, not necessarily a return on your money. When we talk about the stock market, the Dow Jones, any of the indexes, and that they say, oh, the market was up, that's a return on money that you already had. When the annuity company says we're going to pay you an income level of 8%, part of that 8%, or actually a large part of that 8%, is your own money coming back. So the concept of the annuity is, here's a lump sum. I'm afraid, I don't want to outlive it, so I'm going to give it to you, Mr. Insurance Company. You promise me income for the rest of my life, and I know that no matter what, I've got that income coming for the rest of my life. If you don't live as long as you thought, you're leaving money on the table, because the annuity is designed to exhaust itself, not give you some kind of legacy you can pass on to the next generation. We're big fans of, let's not dip into the principal that heavily. Let's allow that money to be there for a while. Right now, a lot of our clients who are noticing this high inflation have had to increase their income a little bit to keep up with it, and that's okay. We built that into our model of deciding what type of income stream we would develop.
Sure, because our philosophy, of course, is looking at things over extended periods of time, and you're not going to have every year being positive in terms of an investment allocation, but over time, certainly there's been the ability to achieve those returns of 7-8% in terms of the historical numbers on the overall markets. And so when you think about these annuity sort of pitches, let's say you're 65 years of age, average life expectancy, if you're 65, we were talking about that last week or maybe the week before on the program, is about 20 years. So if I give $100,000 to into an annuity, they say, oh, we're going to send you 8%, that's $8,000. The math on that actually winds up being not nearly as good as the first line sounds.
Of course not. It's 8% income. If some of it's your own money coming back, that's not really a return on your investment. Again, they're just giving you some of your money back. We like the idea of controlling that principal, controlling your investments. Let's say the 8% sounds good for a while, and all of a sudden you need a little extra money. Can't be done with the annuity.
That's true, because once you do more than that, then it undermines the guarantee. So if you stay with that example of that $100,000, put $100,000 in, I'm going to get $8,000. Okay, great, I'll live for 20 years. That means over a 20-year period of time, I got $160,000, but $100,000 was the return of my investment. So my return on my investment was only the $60,000. Divide that by 20, that's $3,000 a year on my original investment
of $100,000.
Of $100,000, that is a return of only 3% on my actual investment. I mean, you can do better in a CD right now versus that kind of a concept. So that's the importance of just sort of understanding some of the language that gets talked about versus the nuances of what that language actually means, that concept of return of investment versus return on investment.
Right. The bottom line is to know what type of investment you're looking at. What is it designed to do? What is the actual return you could achieve? What is the interest rate? What is the yield? Those are things we can obviously help clear up. So as you are, our clients and prospects are out looking at other things that are starting to catch your interest, run it by us. Let us tell you exactly, break it down what you've got, because there's a lot of interest in what's going on in fixed income products right now because of the way rates are.
Yeah, certainly it has attracted a lot more attention than it has in the past. I mean, if we think about money market rates, and I think about the money markets that we have through our mutual fund, our various mutual fund companies, for the better part of 15 years, they were basically zero. I mean, non-existent. It wasn't even worth having a conversation. And now all of a sudden, they've jumped up to about 4.5%, which is a pretty significant rise in a short period of time. Obviously, directly related to what the Federal Reserve is doing now, having raised rates by 5%. Then not uncommon to see 4.5% now on a mutual fund money market. That's for sure.
And what's nice about that money market compared to, say, a CD or anything else is that we can quote an annualized yield right now, but you're not locked into that rate, and you don't have to stay with it for a whole year or you get penalized. And as interest rates have gone up, and yesterday another small raise, the money markets are going to follow suit. So it's a great place for your cash type investments, competitive yield, extreme amount of liquidity, even check writing options.
Especially, versus the banks, because that's one of the things the banks have been reluctant to do is to increase the amount of interest on that. And we sent one of our regular communications to our clients earlier this week, kind of talking about that. And one of the things that we always commit to our clients is that, we're not going to tell them to do anything differently than what we haven't done with our own money. So a couple of weeks ago, I got just tired of kind of looking at my money sitting in the savings account at a large, banking institution and not really making anything. And I'm like, why am I doing this? Why I need to move this money out of my savings account and get it over to the money market so that it is at least generating that. Now, let me be clear. We're not advocating this as your investment strategy. These are two different concepts here when we start talking about money markets and things like that. Great places to put your emergency savings, your general savings, those kinds of things. But as we said earlier in the program, if you think that's going to be your investment strategy, you're going to fall short, particularly because of where inflation is.
Very much so. We see the money coming into the money market. We understand why it's going to do so. Down the road, stock market's a little bit of momentum going on. If you're in a money market that's part of a mutual fund company, you're set up great to set up some kind of a dollar cost averaging, methodically move the money back out of the money market into the stock market, catch the highs, catch the lows, have a nice average cost. We've always been an advocate of there's no reason to dump all your money into the stock market day one. But you've got to be in the stock market to get stock market kind of returns.
Sure. Once you're invested, then you stay invested. But ultimately, if it's cash coming in, then there's always a good strategy of trying to do that systematically and regularly over the course of time. I wish we were so good and be able to see the future clearly that we could sort of pick all those times, but there's no way you're going to be able to do that. So then the strategy of putting in a little bit of money each and every month, so that the money ultimately winds up getting invested over the next year or two, we think that's probably one of the best strategies to do. And certainly there's a lot of studies that say that the dollar cost averaging approach is a great way that helps to smooth out market volatility.
Very much. You've said it before, and I know you'll say it again, and it's so accurate. It's not timing the market. Your long-term growth doesn't come from trying to pick and choose when to be in the market and when to be out. The long-term growth, the successful strategy is just spending time in the market. The stock market over time produces some great average annual returns. The only way to get those returns is you have to be in the market a pretty good amount of time.
Well, but you certainly do have to change the lens, because I think that this is where folks are easily distracted, because the lens out there, it's negative, negative, negative. And if you were to spend any amount of time watching the news or scrolling media, the reality is that that's going to just change your perception, because certainly all of the news is on the negative side. And then that creates this impression that, oh, wait a minute, everything else is negative, or the world as a whole is negative. And the reality is that there's probably more good out there than bad.
Very much so.
Well, that's about it for this week's episode of Dollars and Cents with Joel Garris, Rob Field of Nelson Financial Planning. If you like what you heard and want to learn more about how our team of certified financial fiduciaries at Nelson Financial Planning can help you change your life with a successful and cost-effective financial plan, go ahead and check out our website, nelsonfinancialplanning.com, or call 407-629-6477.